You have a job and you'd like to buy a house, but you don't have money. 10 years from now, you'll have the money, but right now, you don't have the money, but you really need the house. Maybe a mortgage can help you. You may have heard the word mortgage before. A mortgage is just a loan from the bank that you get when you want to buy a house. Let's say, for example, you want a house that costs 1 million pesos, but you only have 400,000 with you right now. You'd have to borrow 600,000 from the bank, and that 600,000 would be the mortgage. A mortgage is special because you use the house as a guarantee or collateral. In other words, in the event you're not able to pay or when you default, the bank gets the house. That's the reason why the actual French translation of mortgage is def pledge. Mort and gage, mortgage in French. So mortgage literally means death pledge because if you're not able to pay, you die, figuratively. Another explanation is that the loan dies down once you pay all of it. But the first one's cooler. Anyway, a mortgage is not that bad. It's actually very good. It allows for many people to actually own the houses they live in rather than just rent. Except for the financial crisis in 2008, which was caused by subprime mortgages that were given out to people who couldn't pay for it. More on that later. I'll just go through some basic terms that you might encounter when getting a mortgage. Amortization is the spreading out of payments for a loan, because you commonly make mortgage payments monthly rather than pay for the entirety of the mortgage at one time. An escrow is a third party trusted by the bank and the buyer. Escrows exist because it serves as a reserve of the money, a place where both parties deposit the payment and title for safekeeping. Title is ownership of the house. The deed is a document that states the transfer of the title. Market value. Market value is the valuation of the house depending on what similar properties are being sold for in the area where the house you want to buy is in. So for example, if a 20 square meter condo near UST sold for 2 million pesos, I would expect a similar condo near UST to have a market value of 2 million pesos also. That is market value. Appraisal value is the valuation of the bank, and it is a more important valuation when calculating for the amount of money you can borrow. Usually the bank is willing to lend 60% of the appraisal value of the house. That's in the Philippine setting. The other 40% you have to make as down payment. Important documents you need to submit for appraisal purposes are the photocopy of the title, the tax declaration, and the bank might also want the house to be inspected to properly determine how much the house you want to buy costs. Now, the most important thing for a bank when giving you a mortgage is your capacity to pay. Because a bank wants to make sure their money is safe, and although you would think a bank would like to get possession of the collateralized property instead of payment, that is wrong. Because a house is not money. Banks don't really get that much use of houses. And a bank often has trouble selling a foreclosed property at a reasonable price. That's why most foreclosures are sold for way less than they are actually worth, because the bank wants to get rid of the house and make it into cash as soon as possible. So banks like it more when you can pay than when you can't. So to make sure you can pay the mortgage loan, a bank most often requires you submit one, a certificate of employment to make sure you have a job, a way of steady income, to make sure you can pay for the monthly mortgage payments, and your bank balances to make sure you have things saved up in the event they want to collect their money. A bank also takes a look at your credit credit score. It does this by checking. It takes a look at your previous loans and how you kept your promises and paid for them. In credit checking, a bank asks other banks where you got loans before to see if you actually paid the loan back. If you have good credit, a bank will be much more likely to approve your mortgage and give you lower interest because there's less of a risk for them to take in loaning to you. In the States, in the US, they do this through credit rating agencies like Moody's, which keep track of everybody's credit there. But in the Philippines, we don't have this and that's one we don't have credit rating agencies, and that's one of the reasons why interest rates here are higher compared to the States, because our banks don't have much information, so they're forced to give out higher interest for loans. But I've heard there may be a credit rating agency set up sometime next year, so that's good. Banks here use the loan decks and communicate with other banks to determine how credible you are. So thank you, and I'll see you in the next video.